Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options.
Vega is going to actually, remember, these Greeks are risk gauges. So this is the risk gauge for telling us as traders how much I'll make or lose based on changes in implied volatility. 1 unit change in implied volatility. I can go to a site called ivolatility.com and I can type in CDD, get the European style, put in the value. When I look, this is 106. It's actually, I think, down to 104. Number of days expiration, I typed in 13.75. That was about 8 weeks ago. Believe it or not, volatility has declined significantly in the last 8 weeks. And then I put in the interest rate. What you'll find here is that the values it's very interesting. You know, you can get the delta, gamma, theta, vega, and rho. So you, as the trader, can understand where my risk is. You know, what happens if nothing happens, or I lose about 2 cents if I buy this option? What happens if the exchange rate moves up a point? I make about 52 cents, or I lose 48 cents, whatever. So let's go through it. CDD trading 106, the call might be 186. The call delta is about 0.52, meaning if it goes to 107.05, this option would be worth about 52 cents more, or 238. If it goes down to 105, it's worth about $1.34. Goes down, the put's going to be worth more, or if it goes up, the put will be worth less. Most brokers are going to offer something like this, where you can actually look at your price of your option and the time value. So the yellow line basically tells me that it's at expiration, it's a linear proposition. Basically, you have no value until it gets over 106, and then it starts to gain some value. Prior to expiration, you see that sort of purple and blue line telling me that my option has value and has some time value anytime prior to it, and it gives me an approximate value based on certain volatilities. Delta, well, looking at a call, makes sense that the call option is going to have higher delta as the asset moves up. More delta as it goes up. As it goes down, lower deltas. The changing delta, what's that called? Gamma. I hope you're all enjoying this today. This presentation, you might want to go back, listen to it again, because there's a lot here. There really is a tremendous amount here, because the option Greeks are, some would say they're very, very easy, but if you haven't been around the options market for a number of years, you might find them to be, you need to really go through these numerous times. So again, I'd urge you to do that. Gamma, as I mentioned, gamma is going to change my delta, so I could get the call gamma. Look at the put gamma, and basically what it's telling me is my new delta. So I might have had a 52 call delta, and if the stock goes down, I'm going to go down to about a 43 delta. Or if the stock goes up, the stock, when I say stock, it's the exchange rate, goes to 61. It's very, very important to understand what happens. The put is going to increase if it's going down. You're going to have higher, and then otherwise the delta is going to be lower. Again, this is assuming no other change in the other inputs. And I hope this illustrates the point that I made just a couple moments ago about the gamma being greatest at the strike price. So if I was concerned about time decay, I might not buy the at-the-money option, because the at-the-money option is going to have greatest gamma and therefore more theta. You see that right there at the strike price. Really love this slide. It just does a great job of explaining not only the call option gamma, but also we'll get to theta in a second. Gamma by duration. Remember what I said was that as we get closer to expiration, gamma might increase, especially at the strike price. So at the money options, we might see a pretty normal gamma, but then all of a sudden, around the last 7-8 trading days, look what happens. I mean, we see a skyrocketing gamma. So take a look at options, and I think you can go to EUU and look at, well, you can basically look at any of them, but if you want to, at the end of this presentation, you'll see at the money options that 1 day to go. In fact, there's only 2.5 hours. They might be trading at 30, 40, whatever, 50 cents. They might look rich to some of you. They might look cheap to some of you. If there's only a couple hours left, that's all extrinsic premium, and that is really the definition of gamma when you only have a couple hours left. You have the rapidly changing delta. If it's at the strike price, you have a 50 delta, but we know that tomorrow at this time, these options will not have a 50 delta. They're going to either pay off or they're going to be worth 0. So we can look at the theta, which is the change in the options value for every 1 day decrease in time. To buy this 106 call, it's going to decay about, well, let's just round it to 3 cents. So $1.86 is going to be worth $1.83. $1.59 worth roughly $1.56.5 or something like 56. Theta at the money options. Remember, I was talking about these at the money options. Well, the at the money options, what this is showing is that as we get closer, theta is going to really pick up here. And what we're showing here is the call option price. And as it gets closer, it starts to spike downwards. You're seeing rapidly changing option price, considering it doesn't move. And what you're also seeing is significantly higher thetas as we move through time. Vega is going to measure changes in the implied volatility. So what happens if the volatility goes from, let's say, 13.75% to 11.75% or 15.75? This is really important to think about because I want to know how much am I going to make or lose if the options change the volatility. So I can actually, I call it stress testing my position. I could say, okay, what happens? It's trading at 13.75, but you know what? Maybe it goes down to 11.75. You know, I might want to really, oops, that's not 160. That should be $1.60 and $1.33. Sorry about that. But the options would be worth significantly less if the volatility declines and significantly more if the volatility increases. Volatilities as of last November. So the euro, let's say the 1 month vol was around 11. The yen was about 14%. This is courtesy of the Federal Reserve Bank of New York. Swiss franc, 11.7. British pound, 12.3. Canadian dollar, wow, 14.6. If we knew today what it was way back when, I might have looked at option strategies that were going to predict lower volatility in the Canadian. Because what happened? Well, the Canadian vol went down to 11.6. Let's just take a look at that. 14.6 on November 30th. Now it's, well, this is as of January 29th, 11.6. The volatility has declined, and that, you know, we've seen that in many, many assets.
Thank you for participating in this week's session. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.